Can you remember the last time that we had a market like this? We got the President of the United States threatening the rest of the world because of some huge inflationary event that's going on where he wants the oil in the Middle East down from prices after it raised 60% since the start of this war. He's threatening Iran's water, their energy. On top of this, we have a super weak market right here where we have a market every day. It starts super up, around up to 1% at open today. And now at the very end of the day, nearing this time, it's down 64% of 1%, which is unbelievable. And just so you guys know, this is a super weak market because usually strong markets are going to come in and they're going to start low and then close higher and barely eke out a green day. We got markets right now that are eking out red days. On top of this, we have a 2-year that actually came down today, but still super high, pricing in almost rate cuts, hikes. And then we got an AAIA investment survey. The last time we saw this was when was that same event again? April of last year. Whenever you have readings of over 50% on the bearish side. And then on top of all this, we got a VIX making its highest peaks of over 30 since what happened? Again, last April. Today we're here to tell you, is this a repeat of last year's April where Trump's just going to end this war and the economy's going to be fine and you're going to have a huge V-shaped recovery like happened last year? Or is this going to be more of a drawn-out recession due to some other factors that play that we did not have at this time last year? And finally, to end this video, we're going to go through some of our best stock picks that we think we have for you to buy right now that you're going to have unbelievable gains on for the next year, 2 years, 3 years, 4 years, and 5 years. Let's get right into this video today, and we're going to show you what we're looking at in the market. The first thing that I think the most important thing that we've really seen in this market happening right now is Fed Chairman Powell has been speaking today at market, and he suggested that a rate cut this year was still possible, even though we have a GSG flying up. We have a PPI, a CPI, PCE coming hotter than expected recently, and we have oil prices just flying. He said there could be so much downside to the labor market this year that the Fed is actually forced to cut and take the priority of the labor market instead of waiting for anything else to happen, possibly raising rates, cracking private credit even more, or cracking the unemployment, leading to a huge recession in our economy. While markets are pricing high inflation and no rate cuts recently, this seems like a little change in the Chairman Powell. And basically, the odds of a Fed rate hike actually fell down to 22%, which, like we said, whenever you want to go and check if there's a rate hike or a cut, the 2-year is going to signal what they think the Fed funds rate is doing. So if you see a 2-year falling, that means there's less chance of a rate hike or maybe less rate hikes or more rate cuts. And if you see a 2-year rising, like we've seen since March, you're going to get a Fed that people think are going to go and hike rates. And whenever you hike rates, what happens? Basically, a lot of these companies on Wall Street and big analysts, they're going to go run something called a discounted cash flow analysis. And within that discounted cash flow analysis, you're going to have a discount rate, either like CAPM or WACC, that they're going to use various factors like the 10-year. And the 10-year likes to go up because of inflationary concerns. So whenever inflation somewhat goes up, your discount rate gets higher because of the 10-year and these yields tracking that, which in turn, a higher discount rate makes it seem like a stock has a lower intrinsic value. So basically, whenever they see that stocks have lower intrinsic value, there's less buys, or maybe they trim positions, and then that's whenever you get a market going down because they don't think these stocks are as valuable as they could be. So that's what the huge thing, and that's what inflation does. But whenever you have a rate hike, like I said, you're going to have your treasury yields follow it down, so your discount rate is going to get smaller. So those intrinsic value stock prices get higher, and more money is going to pour into the market, making your investments go so much higher, and you have so much a return and prosperity in the business cycle. So that's really what you have to be thinking about this today. Let's just look at the labor market expectations and the inflation just from the New York Fed, right? So they actually have their unemployment rate. They think it has less of a chance now to go higher 1 year from now, even though Fed Chair Powell is out here saying today that, hey, we think unemployment still could get out of control. It's at levels that we think are elevated using labor productivity rate right now. And that we're going to have to cut rates instead, even though we have inflationary pressures, because the unemployment is going to get so much more out of hand than inflation. And just a good analysis also happening right now is you could argue oil prices are very deflationary, because think about what happens, right? We've had videos about this before. Oil goes up, that means gas goes up. Oil, say you have gas at $4, $5, maybe even $6. What happens? People have to go and end up spending more money on gas. So say they're spending $50 on gas a week right now. What if gas doubles or goes up by 60%? Now they spend $40 more next week per person in a family. And what does that do if you're spending another $100, $200? You don't have that $100, $200 a week to go buy a new Xbox, new drinks, go out and get dinner, and stimulating the economy because you're putting more of that to energy. And also what happens whenever companies are shipping money back and their products back into the US, importing it. Basically, whenever they are doing this, these prices are going higher and you're paying more for the prices. So instead of buying 6 of something, maybe you only buy 4 of something. And what does that do? That hurts the companies. And what do they have to do in turn? Whenever they're making less money, they lay off employees. And then wherever you lay off more employees, less people are making incomes and they're going out and spending less. So that's the argument with this, that this could actually be deflationary and hurt the labor market even more. And inflation could actually go down, which would be the best case possible scenario for this, because you get a Fed to cut rates to help private credit, stimulate the economy, and they also would be able to keep the labor market in check. And then basically they have the median household finance at 2.9%. So just from all this says that home prices going up, inflation going up, PPI, those, are they going to get past the consumer, or is there not going to be enough demand in the future because people are spending money on other items, is the real question that you should be asking yourself and everybody else in this economy should be asking. Because whatever usually, like we said, everything, let's just go back here to the AI investment sentiment. What happens at this? What happened at April? Everyone was bearish. Then it shot up from a V there after it was super, super high. Everyone was scared. So just because everyone's like, oh, this oil is going to be an inflationary crisis, which it has led to those in the past. I'm not saying it's not gone up. Maybe the odds favor it. But if everyone's loaded up, thinking, hey, oil is going to be higher right now, gas is going to be, maybe they're spending less right now and they're going to be spending less as it goes up more and more. Another good thing for this economy that makes me think that it's going to be okay is you've got a VIX over 30. Historically, anytime you have a VIX over 30, let's just go look back. We have our VIX over 50 right here, April, V-shaped recovery. Then that last August, you had a dip down. Let's just go back and look into 2022-ish, right? 2022. You had those VIXs going 36. What happened? Economy, the SAR, boom, all the way up now, almost doubled since those lows there, right? Let's go back to COVID, right? Up to almost 80 here. And what's happened? Huge V-shaped recovery again, like last April. So just these are all these indicators that you can look at for the market to say, hey, should I be buying right now? Because the market doesn't bottom whenever everything gets, oh, good, all of a sudden the war's over. The market bottoms on bad news. You can look back at every little thing. Bad news marks the market bottom. And it's more when are people done selling that they finally oversold and that they're saying, hey, we've already priced in the dangers of this happening. The probably 10 times worse than the dangers of the event happening. If this keeps happening, we've already sold off enough where it starts to make sense for us to buy right now. And that's what you historically see. The market will bottom 6 months before something resolves. Because what is the market? The market's always forward moving. That's why, what do we always tell you to look at for P-wise? You want to look at the forward P. You don't want to look at the trailing 12 month. You want to look at the forward, because now it's based on analysts and maybe that's whatever. That's a different story. But the market's always forward looking and in the future. If you're staying at the data or waiting for something to go right and not taking that risk, you're going to be buying whenever the market's almost back at all-time highs, and you're going to be doubting that it's going to be coming up. But if you use these psychological indicators to say, hey, I need to buy today, I need to buy right now, that is whenever you're going to get the best deals, and that's whenever you're going to get those 10Xs coming out of recessions right now. And we just want to go and show you what we have doing in our projections, and we think why you should be buying these stocks, everything right now. So let's just go here. Let's just go into this right here, right? Let's look at Zeta right now. What's the price out? About $15. And let's see what SoFi is about, right? $15 for these two, all the way down from $32 to $15. Over 50% down. You're getting this stock 55% off. And just wait till we show you the numbers. We've preached about great management, great beats. They sandbag, and they should be trading much higher. Zeta, same exact thing. Freaking, 17 quarters straight of triple beats, beat and raise. They're all the way down from 25. I mean, they got higher in 2024, way up there 40. But let's just look at this. From 24 down to 14. They're almost 50% off also. And even better, we're just going to go and we're going to show you what we have running for our projections for these stocks and say, hey, like, let me go and do this right here. this thing always is slow. This thing makes everything super, super slow with my computer whenever I don't know what's going on sometimes with all of these events and whatever happening. But that's different problems. Technology problems always happen. But let's go here right into Zeta, what we have for our base case of this stock, right? We just showed you under $15. We can just go and put in $15, right? What are you getting at our base case for this year? And you shouldn't be worried about what does it do in the next year. You should be worried about asking yourself, what are these stocks going to do for me in the next 3 years? Because anything can happen in a year. Did any of you think the Iran war was going to go and happen? That all that was going to happen? Did any of you think that the tariff crisis was going to happen? You have no idea. But what is one thing that you always, always, always have heard about the market? The market always rebounds. Buying the dip is always a great move. Maybe it doesn't look like that 1 week after, a day after, a month after, even a year after. But eventually the market always comes back up, and you always are going to get your intrinsic value of stocks as long as their fundamentals stay good. You make sure they don't have a lot of debt and they have good management leading the company so that they can get through those bad times. That's what you should be worried on. You shouldn't be worried, oh my gosh, the market's down, my portfolio is down 5%. That's what you should not be thinking about every day. You should be happy almost whenever your stocks are going down, because you should have money sitting there of your portfolio to buy dips. Because say we're at all-time highs, right? So say we're in January and you see the S&P finally make another all-time high. You should not be 100% in at that point, because the 4Ps you had high. You had a lot of margin debt. Buffett indicators, all these were high, and you had a sleepy VIX out at 12, right? At those times is whenever you should be not worried about taking risks, and you should be worried about your positions. Right now, whenever you have a market down and you have stocks down 40, 50%, maybe some of them, if we keep going down even more, another 10%, you're going to get these 80% off. And imagine you got this stock here, right? What if you have this stock go into about 120, 130-ish in 2029, and you get this stock under $10? You're looking at almost a 15x in this stock from that price, just with our base case and just using their numbers. So that's what you have to be looking for the long game, because you can't be one of those people who's on CNBC saying, oh my God, my portfolio, what is this guy doing? There's going to be these people always out there. You don't want to be that person tweeting on Twitter, this guy's going to do this, do this, do this, do. You're looking at this as an opportunity, and you're happy this is going down. Because as long as this doesn't fundamentally affect your business, something like a war right now, could it lead to inflation? That could be a problem. But something that's not directly, and they're going to come back over time, you should be loving that. You can get these prices at unbelievable times. So what do we have for Zeta, right? We have them growing a revenue growth 35%, net income at about 45% in the years, right? They just turned profitable, so that's why you're going to see a 1,600% clip. 45%, 45%, 45%. Whatever they have in their guidance, that's what we have them. The revenue growth going down a little bit each year. Okay, that's right for a maturing company. With that, a 50-60 P ratio for a SaaS company that has they own the first-party data, they are the AI, they are the disruptor, that has great management and keeps beating. That's the company that you're looking for after you understand them. And right now, from $15 a share to about $135-ish a share, you're getting about 8x around there, not like 8 to 10x, 7 to 10x within that range, just from these prices right now. This could even only get a better deal for you. So that's what you have to be understanding about. Like, you need to have money prepared for, is it going to keep going? And then whenever you hit those psychological indicators we talk about, right? You have your VIX over 30. You have your investor sentiment. Everyone is bearish, thinks it's going to go down over the next 6 months. Bam, that's whenever you come in and you take those opportunities and you make life-changing gains that you're looking on in 5 years, and you're like, I'm so happy I did this. And other people are like, well, why? How did you know? Why did you do this, right? The people that are talking so much about this right now, worrying, never going to make money. You want to be the opposite person, looking at stuff in a good way, and that's just how you have to live life. So this is that's what we have for Zeta right now. Let's just go show you our SoFi numbers. And even Zeta, we have from this right now, this could be a 3 to 4x this year if the economy does bottom and gets really, really good eventually, and the P's and valuations come back. Other stock we have is SoFi, right? $15 a share right now, and we have it by 2028. We have that going to around a 70% midpoint, which our numbers, right? They sandbag so much, they might even be low because they add new additions, they dilute people, have extra cash on their balance sheet, which, what are they doing? Everyone's like, they're diluting us at $27, $28 a share. The stock is $15. That's just great management knowing what's coming. Now all those people, like I said, don't be a naysayer or something happening. Look as an opportunity. They probably sold out after they saw stock go down 10 more, and they're not going to buy. They're not going to trust it, and they're going to be buying back at 40 whenever it goes finally back up, being like, dang it, I missed out. Now it's going good, and they're going to get killed again. This stock right here, SoFi, in 3 years, you could be getting around a 5x on this stock. And the thing is, these companies are going to get hard. Like a financial company could get hit. But the difference with SoFi and what we like it, they're an asset-light business model, correct? So think about your big banks, like your JP Morgans, your Deutsche, all the big boys, right? Morgan Stanleys. These companies have huge loans on their balance sheets, and they keep them on it, right? So they get screwed in a recession or something happening because companies default and can't pay back those loans, and they're stuck with them because, hey, they made a bad loan. SoFi, on the other hand, is a lot more protected, no matter what Muddy Waters lies and says. They go and they sell off their loans to other companies. So basically, they're a fee-based recurring revenue model almost. It's not recurring revenue, but a fee-base is what you want to see. So say the economy goes south and companies can't pay off their debt. They're holding a very, very, very small portion of that loan on their balance sheet, right? Or it's already fully sold off. So they don't get hit as hard. And whenever that recession hits the bottom or the market bottom happens, they go bang out there, right? Remember what happened to them last year? Went down to $8. They went up to $32. You 4x your money if you bought them at $8 in a few short months, right? So this is the type of growth that this company has and the type that they get disrespected. And these are the companies you want to find that have been able to get out of these recessions, that have gotten disrespected, and start loading the boat at these times. And whenever you also see the market down, right? You want to be buying these growth plays with these big numbers, 45% net income growth, your 75%, your revenue growth in the 30s, instead of like your Walmarts, which are trading at crazy P ratios during these recessions because people start flooding them. So that's also another timing in the market where whenever the market you see it down and these companies are going to get disrespected and hit hard at the start, you want to buy them whenever the market's going down. And consequently, whenever the market's going up and you're seeing all-time high, all-time high, all-time high, you want to be taking your risk off and getting into better, more defensive companies that in case something happens to the market, money's going to flood into them and you're going to make a little bit of money or even lose a lot less than have it to put back into these companies. So after you learn how to stock pick, that's more of the game. But thank you guys so much for watching today. Please leave a like and subscribe if you enjoyed the video and you want to see more of this in the future. And if you really want to see anything, any topic from Trump to Iran to any other country in the world, anything from private credit to Fed, Chair Powell, interest rates, inflation, all that, just leave us in the comments and we're going to make sure to include that in the next video for you guys.